What are the top financial metrics that investors want to see in a fundraise? Are you about to fundraise or you're preparing for a fundraise, whether that be seed, Series A, or Series B, and you're wanting to understand what are the metrics that you should be putting together? Today, I'm going to go through the top that I've seen while working as a fractional CFO that investors are really keen on. Hi, my name's Alysha Randall from Fast Growth Consulting. I'm a fractional CFO, and today I want to go through metrics. So the first one is monthly recurring revenue or annual recurring revenue. So these are sometimes referred to as MRR or ARR. Basically, it's showing what revenue you're getting each month or each year. It's really important because it shows what is predictable and your traction. So the investors, therefore, are very keen on that because it helps them predict the valuation of the company and potentially the valuation in the future. So they want a clear breakdown of MRR growth. They want to see what is new revenue and what is retained or recurring revenue, because that's easier to be relied on. And ideally, they want low churn. So you really need to be ready to show how your MRR is calculated, how much is locked in, and how much is at risk. The second one is gross margin. So this is revenue less cost of sales equals your gross profit or gross loss, and that is as a percentage of revenue. So this tells the investors how profitable your product or services are before your sales and marketing costs and before your overheads cost. So ideally, you want to be in a position where your gross margin is quite high. So as you're growing your revenue, your gross profit is also growing. So you have more money to spend on sales and marketing and overheads. So with tech SaaS, for example, you may be, say, 70 up to even 95% gross margin. If you're working in e-commerce or retail, this will be down to about 20 to 30% gross margin. So this is probably why SaaS businesses have been quite popular with venture capitalists over the last 10 years, is because they have high profit margin. The overheads, however, are quite high as well because they're having to invest in tech and R&D. So this is something that you really want to understand well. It's also great if you can break this down by product line or channel so that you can demonstrate your mixed offerings, particularly if your core product has really low margins, but all of your add-on products that you're offering existing customers is high profit margin. This may be one of your strategies, and therefore your gross margin will be increasing over time, which is really interesting for an investor. The next one is customer acquisition cost, or CAC. So this one shows how efficient you are at acquiring new customers. So essentially, how much are you having to pay to get one customer? So the investors are looking for the CAC figure. So they want to understand that in comparison to how much revenue you're expecting to get from a customer once you've onboarded them. They also want to see that you've got your CAC tracked consistently. So every single month for the last 12 months, for example. They don't want to see just CAC last month because that was your best month. Ideally, CAC by channel if relevant, but if not relevant, blended is fine. And they also want to check in your growth model that the CAC isn't increasing in time along with growth. Ideally, they want the CAC to be relatively stable and relatively predictable. The next one is your CAC payback period. So this basically will tell investors how quickly you get that acquisition cost back. So if it costs you, say, £10 to get a customer, and a customer will pay you £1 every single month, then it will take you 10 months of £1 revenue to pay back that £10 initial cost. And of course, the hope is that the customer stays longer than that, and that's when you start becoming profitable. 12 months or less is considered relatively healthy for most startups. A fast payback period, so the shorter that time frame is, the more efficient you are at scaling. The next one is lifetime value, LTV, and then also the LTV to CAC ratio. So the investors are interested in this one because it shows them how much a customer is worth over time and then what you spent to acquire them, which is part of the CAC ratio. So if, say, for example, we go back to that £10 to acquire and then £1 per month, and it takes 10 minutes for that to stick around. Potentially, if the customer, over the lifetime that they stay with you, say they stay with you for 3 years, then you're going to get a lifetime value from the customer of £36, lifetime revenue. And then you'll have to deduct, the cost, so the gross margin of that, how much it costs to serve this one customer who's paying you £36 over a 3-year period. And then you deduct the CAC cost, which is £10. Now, ideally, you want your LTV and CAC ratio to be 3-to-1 or better. However, sometimes at that earlier stage, particularly, you may find that it's not as good as that, as you are focusing on getting your gross margin to improve over time and your CAC to improve over time. Ideally, you want to use quite conservative assumptions so that you can demonstrate your LTV and CAC ratio, particularly at that earlier stage as you're learning more about your customer and the market. Number 6 is burn rate and runway. So cash runway is basically how many months do you have until you run out of cash. So investors want to know, with cash burn, how quickly you're spending cash. And then they also want to know how much runway you have left pre-fundraise and post-fundraise. So you want to know your runway with and without the new capital. Investors are really interested in how quickly you're going to burn through that cash. So if they invest in you and you burn through that cash in 12 to 18 months' time, much faster than you had pre-agreed, there's going to be some problems. The next one is contribution margin. So this one is the next subtotal that you would have after your gross margin. So what you have is your revenue, your cost of sales, and your gross profit, your gross margin. And then after that, you have your sales and marketing costs, and that gives your contribution margin under there. So it goes a little bit deeper of gross margin. It's also demonstrating how efficient you are with your sales and marketing and onboarding customers. So it tells investors how much is left after the variable costs, after sales and marketing costs, and how much is left to cover overheads and eventually profit. It gives investors clarity on the unit economics, and it also gives sometimes a clear path on how the business is going to be profitable. It also helps justify the scaling spend. So if you're losing money per unit, your contribution margin is negative, so that investors will want to know why you're planning on scaling while you're still in negative. There are situations where this is fine, but you just need to be ready for that conversation. Break-even point, this is when the company is no longer running at a loss. So when will the business stop needing external funding to survive? So the investors want to know the forecast to include how much time you need until you're going to break even. And they also want a credible plan. Ultimately, what investors are interested in is their return on investment. So if they are going to give you £5 million, £1 million, £50 million, they want to know that they're going to get 10x or more back in a few years' time. So what your job is to do is to give them that comfort, give them that reassurance, and demonstrate through your clear vision story, through your products, through your services, through your pitch deck, and through your growth model, that actually that is what you're planning on doing. If you're at that relatively early stage and you're trying to go to market with your first fundraise, I do have a go to market finance strategy checklist that you can go through. And this has these metrics, but a few other things that you may want to consider and plan for before starting your fundraise for your go to market. So click on the link below for that checklist, and that should be able to help you with that go to market. If you're at Series A or going from seed to Series A and you need some financial help, you may want to consider hiring a fractional CFO. Fast Growth Consulting, this is what we do all the time, is support founders in their seed and Series A fundraise. So again, you can click on the link below and take a look at what we offer, but it is often a good idea to have a finance leader to help you with your fundraise. The investors really like it because they know that the numbers have been put together by somebody who does this day in, day out. And also with the finance leader that you have, it's a good idea to make sure that the two of you are aligned. So the numbers are telling the same vision and the same story that you are, and that they're very commercial rather than reams and reams of numbers and complication. So that's a good taster into what metrics you may want to consider including in your calculations and preparation for a fundraise. If you are a founder of a startup, then please do click on the subscribe button below. I try and do a video once or twice a month to talk about finance strategies and how finance can help you maximize growth and minimize risk. I'll see you in the next video. Cheers.